There is one important lesson in this video that we can learn from Warren Buffett that could be connected to all the success in your life. Also, be sure to stay to the end of the video and learn about how Warren Buffett's concept of margin of safety made him rich and can help you make better investment decisions. Warren Buffett, not only renowned for his immense wealth, but also celebrated as a master communicator in the corporate world, has a knack for transforming intricate concepts into memorable one-liners. During a 2001 speech at the University of Georgia, he humorously revealed his secret to a lasting marriage: find someone with low expectations. Amidst the audience's laughter, Buffett cleverly linked this principle to his investment approach, showcasing his unique blend of wit and wisdom. Warren Buffett, the legendary investor often referred to as the Oracle of Omaha, has a profound insight on the foundation of successful partnerships. According to him, managing expectations is the secret ingredient that keeps relationships thriving, whether it's in business or personal life. Buffett's partnership with Charlie Munger, his long-term business associate, is a testament to this belief. The duo rarely found themselves in disagreement, a testament to the effectiveness of their approach to managing expectations. Warren Buffett and Charlie Munger's enduring partnership of over 60 years is a testament to the power of mutual respect and shared values. Their relationship, both in business and in life, has been characterized by a unique blend of trust, understanding, and a clear alignment of expectations. Think about the type of business partner you could be, or who you would want to work with yourself. This is indeed a pillar of support for you to have a successful business. Don't be confused by the term low expectations. Buffett's advice on choosing a partner with low expectations is often misunderstood. It's not about settling for less or lowering one's standards. Instead, it's about setting realistic expectations from the start. This approach helps to avoid disappointment and ensures that both parties are on the same page, working towards a common goal. The key to a successful partnership, whether in business or in life, lies in the ability to communicate openly, to understand and respect each other's strengths and weaknesses, and to work together towards a shared vision. Buffett and Munger's partnership is a shining example of this principle in action. In the context of business, Buffett's investment vehicle, Berkshire Hathaway, has made significant acquisitions over the past century. Each of these acquisitions is a delicate balance of expectations on both sides. Buffett's philosophy is to ensure that his partners have low expectations coming in so that the financial marriage can last. He emphasizes the importance of not overpromising and underdelivering, a principle that is crucial in maintaining successful business relationships. How often have you heard of things blown out of proportion and overpromised when it comes to money and finance? It's tempting to tell people news that you think they are going to be pleased with versus telling the truth. There is another philosophy is also reflected in Buffett's investment strategy. He believes in acquiring assets with a margin of safety, a principle he learned from his mentor, Benjamin Graham. This approach involves buying assets at a price that is significantly lower than their intrinsic value, providing a buffer against any potential downside risks. Margin of safety is a crucial concept in the world of investing. It's all about buying stocks or other securities when their market price is way below what you think they're actually worth. This difference between the market price and your estimated intrinsic value is the margin of safety. It acts like a buffer zone, protecting your investment from potential losses. By setting a margin of safety that aligns with your risk tolerance, you can make investments with a reduced risk of losing money. It's a smart way to invest, minimizing the downside while maximizing the potential upside. How do you calculate the intrinsic value of stock? There are many ways, but one of the simplest is the Gordon growth model. Look that up if you want to learn how to calculate that equation. By applying this principle, Buffett has been able to make successful investments in a wide range of assets. He looks for companies with strong fundamentals, a durable competitive advantage, and a fair price. This approach has enabled him to build a diversified portfolio of high-quality assets that have delivered strong returns over the long term. Warren Buffett's philosophy on investing, as explained through a bridge analogy, is a testament to his cautious approach to risk. He believes in building a margin of safety into his investments, similar to how a bridge is built to withstand more weight than it will likely carry. If the company's performance meets or exceeds expectations, the margin of safety can enhance the investment's performance. However, if the company's performance falls short, the margin of safety helps to limit the downside risk. This approach aligns with Buffett's overall investment philosophy of being fearful when others are greedy and greedy when others are fearful. Warren Buffett's investment in Apple in 2016 is a prime example of his margin of safety principle in action. At the time, Apple's stock was trading at a forward price-to-earnings ratio of 9.5, which was significantly lower than the market average. This provided a margin of safety that made the investment attractive to Buffett. Despite the relatively low valuation, Apple was still a strong company with a solid business model and a competitive advantage in the smartphone market. Buffett recognized this and saw the potential for growth in the company's stock price. By applying his margin of safety principle, Buffett was able to make a successful investment in Apple. The stock has since performed well, and Berkshire Hathaway's stake in Apple is now one of its largest holdings, at least until recently. Watch one other video to learn about how Buffett dumped a bunch of Apple stock and why he did that. To summarize, build long-lasting relationships built on trust and truthful, realistic expectations. Find stocks that are priced lower than their intrinsic value so that you can have a margin of safety to maximize gains and minimize losses.